In this video, I'll show you how to audit cash. It's the most common area that auditors deal with. So when we're done, you're going to know how to audit this very important area. Here's where we're headed. We're taking a look at the primary cash assertions, cash walkthroughs, the directional risk for this area, primary risk. We'll look at common internal control deficiencies. We'll also look at the risk of material misstatement for cash, then how to audit or the substantive procedures for this area. Then finally, we'll talk about common cash work papers. In my opinion, for what it's worth, these are the 5 most relevant cash assertions. They are existence, completeness, rights, accuracy, and cutoff. Now, which of these is most important? So if you had to pick, say, 3 of these as most important, which would you pick? Well, for me, it's going to be existence, accuracy, and cutoff. Why would I say this? Well, think about existence. Let's say your client has 10 bank accounts and 2 of those are really fake. They don't even exist. So as you audit cash, you want to be sure that the accounts that you're looking at really do exist, because sometimes fraud is occurring and the client's trying to make it look like they have more cash than they really have. Now, the other 2 assertions that I mentioned, accuracy and cutoff, those come into play as you look at the bank reconciliations. So as you audit cash, you're almost always going to look at the bank reconciliations that the client has prepared, and you'll look at those normally for the last month of the year. So as you test the bank reconciliations, why are you doing that? Well, obviously you want to make sure that those are accurate. You also want to make sure there's no transactions included in that last month of the year that really should be in the subsequent period. So sometimes the client doesn't cut off the accounting process on the last day of the year, and you may have transactions for 1, 2, 3, 4 days in the subsequent period that appear in the last month of the year that you're auditing. So the client didn't create a clean cutoff. So as we're looking at that bank reconciliation, we want to make sure that it's accurate. So we're going to test outstanding checks and deposits. We're also going to foot that bank reconciliation, make sure that it does really add the right way. And then we're making sure that there was a clean cutoff at the end of the year. So the 3 most important assertions for me are existence, accuracy, and cutoff. Classification normally doesn't come into play, but it can. If your client has a deficit balance in cash on the general ledger, then they've written more checks than they should have, and that now they have a negative balance in cash. When that happens, usually cash is not shown in the asset location on the balance sheet. It's shown down in the liability section. So classification can come into play if there's a deficit balance in cash. So the second consideration in auditing cash is your walkthrough. I have a separate video on that. You can check it out above. But just briefly, we do walkthroughs in each significant transaction area in the audit to make sure that the internal controls are designed and implemented appropriately. Now, once you've done the walkthrough, you may see some control weaknesses. For example, there may be a lack of segregation of duties, that can impact what you're planning to do later on in terms of your substantive procedures. So pay attention to any internal control deficiencies as you perform the walkthrough. So let's shift gears and talk about the directional risk for cash. So if, let's say, your management of the entity that you're auditing and you want to make your company look better than it really is it more helpful to overstate your assets or understate your assets? Obviously, you make the company look better by overstating your assets. And so the directional risk for cash is that it's overstated. Now we're talking really talking about fraud here. This is not where the client has made a mistake. It's where they're potentially inflating the balance sheet or the cash balance to make themselves look better than they really are. So the directional risk for cash is that it's overstated. You want to keep that in mind as you audit cash to ensure that the balances are accurate, and as you audit those bank reconciliations, that they are accurate so that there is no overstatement of cash. You also want to make sure that cash exists, as we said earlier, because if you wanted to inflate the cash balance, one way you might do that is to create fake bank accounts. And let's say you add $1 million bank account that doesn't exist, then you're inflating the balance of cash to make the company look better than it is. So, as the auditors, we want to make sure that all the bank accounts are real. So, what are the primary risks for cash? So, as you're performing the audit, you want to think about these potentials, and one is that cash is stolen. This is probably the most common risk in the cash area because cash is so easily taken. Secondly, that cash is intentionally overstated, as we just said. Third, that not all cash accounts are on the general ledger. So sometimes you may have a client that has another bank account that doesn't appear on the general ledger. Now, this is another form of fraud. So sometimes clients might open a bank account, and monies that are being billed and collected by the company are going to this separate bank account that's not on the general ledger. And then let's say I did that as the CFO and I have signature authority on that separate bank account, then I can steal that money. So number four, cash is misstated due to errors. So we're moving away from fraud here and looking at the potential that the bank reconciliations were simply not done correctly, that we have errors in the bank reconciliation. And number five, cash is misstated due to improper cutoff. So those are the five primary risks for cash. Cash is stolen, cash is intentionally overstated, not all cash accounts are on the general ledger, cash is misstated due to errors, and then the final one was cash is misstated due to improper cutoff. So we talked about cash walkthroughs a minute ago, and as you do those, some of the more common cash control deficiencies that I've seen, dot number one person's doing everything. In other words, there's no segregation of duties at all. This one person makes all the deposits, writes all the checks, posts all the transactions, reconciles the bank statements. They do everything. So that's a common issue in small companies. Bullet number two, the person performing the bank reconciliations simply doesn't know how to do it right. And because of that, they make mistakes. And then bullet 3, the bank reconciliations are not performed timely. So, say a client waits 6 months to reconcile their bank statements, that should not happen. Bank reconciliation should be performed usually within a couple of weeks of month end. So these are some of the common internal control deficiencies that I run into in cash. As you know, the risk of material misstatement for any area is computed by the inherent risk times the control risk equals the risk of material misstatement. Quite often, auditors will assess the control risk at high after they do their walkthroughs because it's just more efficient to do so. But if control risk is high, then your inherent risk assessment is going to drive your risk of material misstatement. Most often we see that existence, accuracy, and cutoff come into play. Well, if the inherent risk for those three assertions is moderate, for example, then moderate times high on the control risk equals usually a moderate risk of material misstatement. Now, if one of those assertions has a high inherent risk, then your risk of material misstatement would be high, and then you'd plan to perform additional procedures. So if you felt like, say, the existence assertion should have a high assessment, well, now what we're saying, we're really going to test more than just the bank reconciliation. We're probably going to perform some type of fraud detection procedures to make sure that all of the cash accounts really exist. And one of those could be as simply as sending bank confirmations. But the higher the risk of material misstatement, then the more work we're going to do in the cash area. Now, usually auditors are going to test the bank reconciliations for the most significant bank accounts. But if the inherent risk for some of these assertions gets to high, then we're going to perform more procedures. So that's why understanding the relevant assertions and then assessing the inherent risk is so important. So here we see some common substantive procedures that are performed in relation to cash. The first we see is confirming cash accounts. The second is vouching the reconciling items on the bank reconciliations. And those two are very commonly performed. I would do that in most cases. And you want to make sure those confirmations are sent appropriately. You may want to look at using confirmation.com and just check that out on the internet, but you'll see that that's a really good way to make sure that these bank accounts are real. The third point here is ask if all bank accounts are included on the general ledger. We said earlier that sometimes a client might potentially have an existing bank account that's not on the general ledger. So at a minimum, we want to ask if all bank accounts are included on the general ledger. And then the fourth point here is to inspect the final deposits and disbursements for proper cutoff. So going back to those assertions, existence, accuracy, and cutoff, you can see how these procedures would appease those particular assertions. So confirming cash, for example, would help with existence. Vouching the reconciling items helps with the accuracy. And then inspecting those final deposits and disbursements, that helps with cutoff. So there's a connection between the procedures we plan and perform, and the relevant assertions that we looked at earlier. So what are the normal cash work papers? So if I looked in your audit file, what would I see? The ones that I most commonly see is the understanding of the cash related internal controls. That's that walkthrough. Then the risk assessments for the cash assertions. So we should see cash appearing in the risk assessment summary. We should see those relevant assertions, say existence, accuracy, and cutoff. And then we should see the assessment of the risk of material misstatement in relation to those assertions. We should see bullet number 3, documentation of any control deficiencies. So after we do the walkthrough or as we perform the audit procedures such as the bank reconciliation, we want to note any internal control deficiencies so we can communicate those later on, but also to see if they might have impact on the planned procedures for this area. Bullet number 4 is the cash audit program. So we develop that program based on the risk above. The next bullet is the bank reconciliations themselves that we test. And then finally, the bank confirmations. So these are the most common cash work papers that I see. Now, you may have others depending on what your client is doing and what types of cash accounts that they have, but these are the most common that I see. In summary, we've taken a look at assertions, walkthroughs, directional risk, primary risk, control deficiencies, the risk of material misstatements, substantive procedures, and common cash work papers. I hope you find this useful as you perform your audits of cash in the future. This video is based on my book, The Why and How of Auditing, and so I encourage you to pick up a copy on Amazon. Always good to be with you. Until next time, I wish you well. Take care and bye now.